Hello there, this is Matt Curfman from Richmond Brothers with a December edition of Matt's Minutes. As you can tell, I'm recording this in the evening, and so lighting is always interesting in Michigan when it's getting dark here about 5:15. But anyways, wanted to say hi in between the holidays and provide you all an update. Between the Thanksgiving holiday and leading up to Christmas, there's actually been quite a bit of choppiness in the markets with all sorts of uncertainty as we deal with another COVID variant possibility, depending on what state, city, or county you're in. There are a lot of ER beds and emergency rooms that are quite filled, and so there's still a lot of uncertainty kind of hanging over from COVID-19 that we're not quite out of the woods yet. That coupled with the threat of inflation and some inflation we're actually experiencing, the threat of rising interest rates from the Fed, tends to tell a story of volatility most recently. In our newsletter that you're getting this with, we also shared an article. If you look at the S&P 500, going back to the spring and even really since the beginning of 2021, that there are literally 5 stocks out of 500, so 1% of the whole S&P 500 accounts for actually almost all of the market's return. And that tells you that 495 companies aren't doing as well. And because the S&P 500 is a market weighted index, that means the bigger you are as a company, the more your return counts for the index's return. So I just wanted to make sure you had a chance to check out that index and check out that article. This is one of the main reasons why we want to continue to use Riskalyze to have portfolios for you set up in a risk-adjusted manner that is appropriate for your own tolerance ranges. Remember that Riskalyze is a scale of 1 to 99, 1 being really, really conservative, 99 being really, really aggressive. And the whole point of getting your portfolio relatively in line with your risk tolerance is so that you have enough of the safety nets and the downside and the lower risk score investments to balance some of the higher risk investments, which can largely be the market or any individual stock, for example. So if you had a risk target or a risk tolerance of, let's say, a 35 or 40, we can certainly experience times where the portfolio comes down. According to Riskalyze, 95% of those circumstances, we should be in those tolerance ranges. For example, maybe a minus 7 or 8% to a plus 12%. That might be an example of a tolerance range. The goal of getting comfortable with your risk score and the way your portfolio is allocated really is to help you ride through and stay invested through these times. It's really, really difficult in any volatility to try to successfully time either buying in or selling out or sitting in cash, just the markets in general. So that's really the goal of Riskalyze. And so we're going to continue to use that as a language to speak to all of you on our individual calls, meetings, or videos that we have to just review portfolio check-ins. As we kind of get closer to the end of the year with a couple weeks left, another real important reminder for those of you who have non-qualified accounts. Non-qualified would be non-IRA, non-Roth, non-401k. So if you have an individual investment account, a joint investment account, a TOD, which stands for a transfer on death, a trust account, for example, those would be non-qualified. Just make sure you pay attention on your Fidelity reports, and you can do this through your Fidelity login or on your monthly statements you get directly from Fidelity. Just make sure and check out the realized gains and losses report year to date, and that'll show you if there's been any transactions in your account that you need to plan for tax purposes. And then also, outside of your accounts with us, if any of you have investments, Consumers Energy is a big company in Jackson, Michigan. If you had Consumers Energy stock that you had sold that we didn't see, that also flows through to your taxes as an example. And so we've had some other clients in the circumstance look for opportunities to do tax loss harvesting. So those are all good year-end strategies to consider and be aware of. It really impacts non-qualified accounts. So again, individuals, joint accounts, TODs, trust would be perfect examples. With that, we also think that through the choppiness, the world is still trying to come out of the pandemic. There's been a lot of sectors that have been choppy and I would say even off. If you look at a biotechnology, for example, index, XBI, which is a SPDR biotechnology fund, it was off between 18 and 20% year to date. The S&P was positive, but if you remove those five stocks, you have a very different story that I just referenced and we shared with you. So we want to make sure you have the appropriate balance. We want to continue talking about your risk scores. We do believe that through the choppiness, the world is still moving forward to try to come out of the pandemic. And companies are getting more and more efficient in operating in a pandemic world. So we think that sets the stage for possibly some positive economic expansion, at least into the first half, if not through the year 2022. We'll obviously be updating you many, many times between now and before the end of 2022. In the meantime, we are honored to be here to help guide you through all of this. Our goal is to help educate you, to inform you, to guide you, to help influence your financial decisions in a team effort to help you move towards your goals. So thank you so much for tuning in. Merry Christmas, Happy New Year, Happy Holidays in general, and we're honored to have the opportunity to serve you. As always, if you have any questions, please call, email, or text us. We're happy to help. Thank you so much.